Assalamu alaikum. Hello everyone. So this video and lecture is regarding the regulated investment companies or RICs, which we may call them, their share pricing, their types and returns calculations for investors. Regulated investment companies or RICs, they are kind of intermediaries whose job is to diversify risk for investors. What they do, they generate pool of funds from the general public investors, and they use those funds and invest them in different classes of assets. So indirectly, they are diversifying the risk of the investors, uh, and they do it more efficiently than an investor can do himself individually. And they sell shares in return of the funds they generate or they obtain from the investors, and they call those shares as units. So if I may explain it to you with the help of a diagram regarding what regulated investment company does. So let's say we have an investor and he gives or invests certain amount in an RIC, regulated investment company, whose job is to pool or generate pool of funds, and then it invests the same amount in different allocations or different asset allocations, which might be stocks or bonds or can be an index or any other thing. So all these different allocations are known or they have different characteristics. In return, the RIC gives the investor a share which we usually call as a unit. So this is the basic function of an RIC. So an investor is indirectly investing in different avenues, thereby reducing his amount of risk, which he could not have done individually. So RICs, they are more professionally efficient in doing this diversification on behalf of the investors. And of course, they charge certain fees for this management of funds and everything. So far, we are not talking about those things. We are talking only about the concepts, how RICs they work. So let's talk about the first point, which is share pricing. Now, RICs, they value their shares with a term we call it as the net asset value, NAV. The formula for NAV is market value of the portfolio less liabilities divided by the number of shares or units, which we might also call them. So a basic example to explain this formula can be, for instance, there is an RIC whose market value is, let's say, $1 lakh. For the time being, let's ignore the liabilities and we assume it to be zero. And there are 1,000 number of shares, let's assume. So units are 1,000. So based on this, the NAV of an RIC can be 1 lakh less liabilities divided by 1,000. So NAV or net asset value is $100. So this is how the net asset value is calculated. The next thing is the types of RICs. So we generally have two major types of RICs. One is the open-end funds, to which we also refer the name mutual funds, and the other one is the closed-end funds. These are the two major types of RICs. So just a brief description of each of the types. Open-end funds, There are certain points to note here. Uh, these are mutual funds, and number of shares are not fixed. This is the point to remember. In an open-end funds, the shares are not fixed. That means the number of shares, they may keep on changing. All new investments into the funds are purchased at the NAV, and all redemptions or withdrawals from the fund are purchased at the NAV. Now, in open-end funds, the name open means that an investor can anytime withdraw or invest the amount in the funds directly, and the number of shares, it will keep on changing accordingly. In the next slide, I'll give you an example, mathematical example of what these two terms mean. Let's take a hypothetical example of an RIC, XYZ, and we have day one. So let's assume the value of this RIC of the value of the portfolio is currently 1 lakh on day one, and units are 1000. So based on the formula of NAV, I can find the net asset value to be 1 lakh minus ignoring liabilities divided by 1000 shares, which gives me NAV of 100 for day one. Now, let's say the second day. Now, one thing you need to remember is that NAV is calculated at the end of the day. On any day, it is calculated at the end. Now, for day two, let's say this is the NAV, which is the previous day's calculation. Now, on day two, there are certain investments in the fund, and the investment is of 2 lakhs, let's assume. That means if each share or unit is of worth $100, so we can say that 2000 additional shares have been added on day two. Because if I divide the same 2 lakhs over the net asset value, that gives me 2000 shares. So my total amount now is 3 lakhs of day one plus day two. This is 3 lakhs, and my total shares are now 3000. So if I again calculate NAV at the end of day two, so this time I will be writing 3 lakhs less zero liabilities, and this time I have 3000 shares, so my NAV is still $100. So the first point that we noted in the last slide was that the number of shares are not fixed. So you can see in day one, on day one, we had 1000 shares. On day two, we are having 3000 shares. So the value and shares, they keep on changing, right? Especially the number of units, they keep on changing in an open end RICs or mutual funds. And likewise, we can also do so for redemptions. So I'm clearing this slide. So on day three, let's say there are redemptions of 1000 shares, which means a redemption of 1 lakh in amounts, because each unit is of worth $100. So if 1000 shares are being withdrawn, So the total amount that is going with it would be 1 lakh. So NAV on day 3 will become, since my numerator has been decreased by 1 lakh now, so I will be having 2 lakhs minus 0 liabilities, and 100 shares have been withdrawn, so my new number of shares are 2000. So NAV is again going to be $100. So this explains two of our points written on this slide regarding the number of shares. One is that they are not fixed, as we have seen in the calculations that number of shares they keep on changing in an open end mutual funds. And second, all new investments and redemptions are made on the NAV. Now let's understand this last point, which says that the NAV may change during the day. It is possible, but on any single day, it will remain the same irrespective of new investments or redemptions done on that day. To see what does this mean, let's go back to our initial example of day 1. We had the total value of portfolio is equal to 1 lakh. We had units 1000, and the NAV was 100. Now let's assume that on day 2 the value of the portfolio increases. Now how it might increase, this is a point we will discuss later on when I'll be explaining to you through it a detailed example. But for now, let's assume that this value increases, and let's say the value increases to 1,25,000. So now the NAV will change. Let's say this is day 2. Now NAV will change because now the numerator is 1,25,000 and liabilities are still 0 to be assumed. And since there are 1000 shares, so now each share is now worth 125. So our NAV has now changed from $100 to $125. Now let's assume that just like we did earlier, on day 2, 2 lakhs worth of investment are credited in the account of RAC. So new investment of 2 lakhs. Now since each NAV is now worth 125, that means how many shares must have been added. So if I divide 2 lakhs by 125, I get 1600. It means 1600 more units have been added. Now if I calculate the NAV with this change, my total value of the portfolio is now 1,25,000 plus this new addition of 2 lakhs. So that makes $3,25,000 minus 0 divided by 1000 shares previously plus 1600 new shares makes 2600 units. So my NAV again is $125. Now this clears the third point, which says the NAV may change during the day, but on any single day it will remain the same irrespective of new investments or redemptions. That means no matter how many redemptions or investments there are in a day, the NAV at the end of the day will remain the same. However, it may change on a daily basis, but during a specific day, the NAV will always remain the same because the change in denominator and numerator is happening by the same rate. Now comes the question that why this value might change from 1 lakh to 1,25,000. So for this, let me show you an example which is a bit more detailed than this one. So let's assume that we still have this $1 lakh and it is invested by the investor who gives this $1 lakh to an RIC. And the RIC further invests this 1 lakh in 4 different stocks or companies. So we call this first company to be company A or stock of A. This is stock B. This will be stock C, and this will be stock D. Now, since 1 lakh has been invested, so as we assume that this 1 lakh is equally divided among these 4 stocks. So that means that per company, RIC has invested 25,000. Now, since these are 4 different companies, so they might as well have their own share prices because they are companies and RIC has invested in these stocks. So let's further assume that their stock prices are $50 for stock A, $40 of stock B, of $25 stock C, and $10 stock D. This is the price of these companies' shares. Likewise, we can calculate their number of shares. So if stock A has a share price of 50 and the RIC has invested 25% in A, so that means RIC has purchased 500 shares of company A. So this might be called as shares. If stock B has a share price of 40, that means RIC has purchased 625 shares of company B, because if you divide 25,000 by 40, you get 625. For stock C, the number of shares are 1,000, and for stock D, the number of shares are 2,500. So that means this is the whole investment procedure which the RIC has adopted so far. Now, the idea that this 1 lakh has changed to 1,25,000 or an increase of 25%. So this 25% change in this value is actually caused by the change in these prices, which brings a change in this value. So let's assume that each of these prices might have increased by 25%. So this is the reason that it has in totality has caused a change of 25% in this whole value. So if we increase this share price by 25% of stock A, so 25% increase becomes 62.5. If I increase stock B's share price by 25%, so my new price is 50. If I increase stock C's share price by 25%, this gives me a value of 31.25. And likewise, if I increase the share price of stock D by 25%, this should give me a change of 12.5 or the new price. Now, these prices are an increase of 25% from their base values. Since we have number of shares also of these companies, so we can calculate the new amounts as well. If we have 500 shares, if RIC has invested in 500 shares of stock A, since stock A has increased by 25% from 50 to 62.5, so now the same 500 shares are now worth as 31,250. It's an appreciation of 25%. Likewise, if RIC has invested in stock B by purchasing 625 shares, and now each share has now increased from 40 to 50, so an increase of this amount is also 31,250. For stock C, the RIC has purchased 1,000 shares, and now each share has now increased from $25 to 31.25. That means the total worth of stock C shares are now same 31,250. And each share of stock D is now worth 12.5. So 12.5 multiplied by 2,500 shares, that gives us again a value of 31,250. If we total all these four values, we get 1,25,000, which is the same change of 25%, which is caused in the value of 1 lakh. So this is the whole idea behind the working of an RIC, why the value of this investment may change in the numerator, which we have seen previously. So this is because of the underlying share prices in which the RIC has invested. When they change, so the value of the RIC's portfolio also changes. So this marks the end of part one of this lecture. In part two, I will show you how to calculate the returns for an investor who invests in an RIC. So if the value of the portfolio of RIC changes, so definitely it is going to affect the rate of return of the investor. If you have any question, please post it in the comments section and I'll be more than happy to answer those. Till then, thank you very much.